the smartest way to invest. If World War III starts tomorrow, turn on the news on any given day right now, and it's a lot. Geopolitical tensions that haven't looked this serious in decades. Conflicts escalating in multiple parts of the world simultaneously. Alliances shifting. Countries that haven't been on speaking terms in years suddenly making moves. And somewhere in the background of all of it, this uncomfortable thought that most people feel but don't quite say out loud. What happens to my money if this actually gets worse? Because here's the thing, most people's investment strategy was built for a world that feels relatively stable. Markets go up and down, sure, but the basic framework holds. Companies keep operating, supply chains keep moving, the dollar stays the dollar. But what happens to that framework if geopolitical stability genuinely starts to break down? What happens to a portfolio built entirely on assumptions of relative peace if those assumptions stop being reliable? That's not a comfortable question, but it's a real one. And avoiding it doesn't make your money safer. It just means you're unprepared for a scenario that historically happens more often than we'd like to think. My name is Jack, and I spend a lot of time thinking about how money behaves under stress. Not just regular market stress, like a recession or a rate cycle, but genuine, large-scale geopolitical stress. The kind of environment where the normal rules start to bend. Because history has actually given us a really clear picture of what happens to different asset classes when the world gets scary. And that picture tells you exactly what holds its value, what collapses, and what quietly becomes one of the most important things you can own. So today, we're going to talk about the smartest way to position your money if global instability gets significantly worse. Not because I'm predicting World War III, but because a portfolio that can survive the worst-case scenario and still thrive in the normal one is simply a better portfolio. Period. Let's talk about it. 1. First, what actually happens to markets when the world goes to war. Before we talk about where to put money, let's talk about what history actually shows happens to financial markets when major geopolitical conflicts erupt. Because the answer is genuinely more nuanced than most people expect. The instinctive assumption is war starts, markets collapse, everything falls apart. And in the very short term, the first hours and days of a major escalation, markets do react badly. Fear spikes, volatility explodes. People panic sell. We saw this in early 2022 when Russia invaded Ukraine. Markets dropped sharply on the news. But here's what most people don't know. The historical pattern for stock markets after major geopolitical events is actually surprisingly resilient. After the attack on Pearl Harbor in December 1941, the US market dropped sharply for about 2 months. Then it started climbing. By 1943, it was higher than before Pearl Harbor. After the Korean War broke out in 1950, the initial market drop lasted about a week before recovering. After 9/11, markets closed for a week, dropped significantly on reopening, then recovered those losses within a month and went on to new highs. The reason markets tend to recover is actually pretty straightforward. War is, among other terrible things, economically stimulating, at least for the countries doing the producing. Defense spending spikes, manufacturing surges, energy demand explodes, and the stock market, being forward-looking, tends to price in recovery faster than most people expect. Now, the important caveat. This pattern holds for countries that are geographically distant from the actual conflict. Countries whose economies remain largely intact. For countries that are directly in the theater of war, Germany in the 1940s, Russia in 2022, the stock market story looks very, very different. So the first principle of war-resilient investing is this. Geographic diversification isn't just about portfolio theory. It's about making sure not all of your assets are concentrated in a region that could become a direct participant in a major conflict. 2. Gold, the asset that has survived every war in human history. Let's talk about gold. Because whenever global instability becomes a real conversation topic, gold shows up, and for good reason. Not because of hype or tradition or people who stockpile canned goods in bunkers, but because of an actual, documented, centuries-long track record. Gold has two properties that make it uniquely valuable in a geopolitical crisis. First, it's a store of value that exists entirely outside the financial system. Gold isn't a company. It doesn't have earnings. It doesn't depend on a government honoring its obligations or a bank staying solvent. It's just a physical thing that has been considered valuable by essentially every human civilization in recorded history. That track record, thousands of years, is not nothing. Second, gold tends to move inversely to fear and inversely to the dollar. When investors get scared, when inflation spikes, when currencies come under pressure, gold typically goes up. Not always, not in a straight line, but the correlation between geopolitical instability and gold price appreciation is well documented and consistent across modern history. During the 2008 financial crisis, gold was one of the few assets that held its value while almost everything else collapsed. During the 2020 COVID crash, gold hit all-time highs. When Russia invaded Ukraine in 2022, gold spiked immediately. When tensions in the Middle East escalate, gold moves. Now, how do you actually own gold? A few options. Physical gold, bars or coins, is the most direct. You own it outright. Nobody can freeze it, hack it, or default on it. The downsides are storage, insurance, and the logistical hassle of buying and selling. Gold ETFs, like GLD or IAU, give you exposure to gold prices through a regular brokerage account without the physical storage headache. Liquid, low cost, easy to buy and sell. Gold mining stocks, companies that mine and produce gold, give you leveraged exposure to gold prices. When gold goes up 10%, mining stocks often go up 20 to 30%. But they also fall harder when gold falls because you're still holding equities with all the usual company-specific risks. For most people building a war-resilient portfolio, a 5 to 15% allocation to gold, primarily through ETFs with maybe a small physical holding, makes sense as a hedge. Not a dominant position. A hedge. Something that zigs when everything else zags. 3. Silver. Gold's less famous, but equally interesting cousin. While we're talking about precious metals, let's spend a minute on silver. Because silver tends to get overlooked in these conversations, and it has some genuinely interesting properties that make it worth understanding. Silver has the same basic store of value characteristics as gold. It's physical, it's finite, it's been valued across civilizations, it hedges against currency debasement and geopolitical risk. But silver has something gold doesn't: serious industrial demand. Silver is used in solar panels, electronics, EV batteries, medical equipment, and a long list of industrial applications. This dual nature, both monetary and industrial, makes silver's price behavior somewhat different from gold. In periods of pure fear, stock market crashes, banking crises, silver tends to underperform gold because industrial demand drops. But in periods of geopolitical tension combined with sustained inflation, which is exactly what large-scale conflict tends to produce, silver has historically performed extremely well. The 1970s stagflation period, driven partly by the OPEC oil crisis and Cold War tensions, saw silver prices rise by roughly 3,000% over the decade. 3,000%. That's not a typo. Silver also has a practical advantage. It's cheaper per ounce, which makes physical accumulation more accessible for most people. A 1-ounce gold coin runs somewhere north of $2,000. A 1-ounce silver coin is around $30 to $35. You can build a meaningful physical silver position in a way that's practically difficult with gold. The way to think about silver in a war-resilient portfolio is as a speculative complement to gold, with more upside potential and more volatility. If you're going to hold precious metals as a hedge, a combination of mostly gold and some silver gives you both the stability of the classic safe haven and some exposure to silver's higher leverage characteristics. 4. Commodities, the asset class that war actually benefits. Here's something that sounds strange but is historically well supported. War is genuinely good for commodity prices. Not good in the moral sense. Obviously not. But mechanically, Large-scale global conflict drives up demand for energy, metals, agricultural goods, and raw materials across the board. Supply chains get disrupted, trade routes get cut off, countries stockpile, and prices for the underlying commodities rise accordingly. Look at what happened in the years following Russia's invasion of Ukraine. Oil prices spiked. Natural gas prices in Europe went through the roof. Wheat prices hit multi-year highs because Ukraine and Russia together account for a significant portion of global wheat exports. Agricultural commodity prices broadly surged as supply uncertainty rippled through global markets. In a genuine World War-level scenario, these dynamics would be multiplied many times over. Energy prices, oil, natural gas, uranium for nuclear power, would spike as global supply chains face massive disruption. Food commodities would surge as agricultural regions become conflict zones. Industrial metals, copper, aluminum, steel inputs would rise as military demand competes with civilian demand on a compressed supply. How do you get exposure to commodities as a regular investor? A few ways. Broad commodity ETFs, funds like DJP or PDBC, give you diversified exposure across energy, metals, and agriculture in a single holding. Easy to add to any brokerage account. Energy stocks, companies that produce oil, natural gas, and other energy, historically perform very well during geopolitical tension. Energy sector ETFs like XLE give you broad exposure without having to pick individual companies. Agricultural commodity funds, covering things like wheat, corn, soybeans, are more specialized, but offer exposure to the food supply disruption dynamic that large-scale conflict reliably creates. The key thing to understand about commodities is that they're inherently cyclical and volatile. They're not a core retirement holding. They're a hedge, a position that appreciates specifically in the environment you're hedging against. In normal, peaceful, stable markets, commodity prices are often flat or declining. That's fine. The point is what happens when things aren't normal. 5. Real estate, the tangible asset that survives almost everything. Let's talk about real estate, because it shows up on the thumbnail for a reason, and that reason is historically well-grounded. Physical real estate, actual property you own, has one core characteristic that makes it uniquely valuable in periods of geopolitical and financial instability. It exists. It's real. It can't be frozen in a brokerage account. It can't be inflated away to nothing. It can't default like a bond. It's land and structure, something humans have always needed and always will. Historically, real estate in stable geographic locations has been one of the best stores of wealth through wars, currency crises, hyperinflation, and economic collapses. In the post-World War II period across most developed economies, property values not only recovered from wartime disruption, but accelerated dramatically as reconstruction demand surged. Real estate isn't a perfect war hedge by any means. Property in a geographic conflict zone can obviously be destroyed, seized, or rendered worthless. But real estate in geographically stable locations, particularly in countries with strong property rights and rule of law, tends to preserve and even build value through global instability. For most people, their primary residence is their largest real estate holding. And frankly, owning your home with a fixed-rate mortgage locked in at a reasonable rate is actually a meaningful inflation and instability hedge. Your payment doesn't change. Your housing cost is locked. In a world where inflation spikes due to wartime supply disruption, your fixed mortgage payment becomes cheaper in real terms every year. Beyond primary residence, rental properties, REITs, real estate investment trusts, and real estate ETFs all provide exposure to real assets that tend to hold value when financial assets are under pressure. The practical point: if you're thinking about building an instability-resistant portfolio and you don't yet own property, the case for homeownership as a financial stability tool is stronger in uncertain times than in calm ones. Bonds. Not all bonds are equal when things get bad. Before we go further, quick, genuine moment. If this video is helping you think about your money in a way you haven't before, if the geopolitical lens is giving you a new framework for portfolio thinking, please hit subscribe. It genuinely keeps this channel going and means more videos like this keep getting made. 2 seconds means a lot. Hit subscribe. And let's finish this because the bonds section and the overall portfolio picture are honestly where it all comes together. Okay, bonds. And I want to be careful here because the wartime behavior of bonds is more complicated than most people expect. There are two very different kinds of bonds, and they behave very differently in a crisis. U.S. Treasury bonds, specifically short-term ones, are considered the ultimate safe haven asset in a crisis. When global investors get scared, they buy treasuries. This happened in 2008 and 2020 and in virtually every major global risk event of the past several decades. The flight to safety drives treasury prices up and yields down. If you hold treasuries going into a crisis, you typically see them appreciate in value as everyone else is trying to buy them. But, and this is important, in a scenario involving very large-scale conflict with meaningful U.S. involvement, the traditional Treasury safe haven story gets complicated. Large-scale war means large-scale government spending. Large-scale government spending means more debt issuance and potential inflationary pressure, which is bad for long-term bonds, which is why in a genuine wartime scenario, short-term treasuries are safer than long-term ones. You're not locked in for 30 years as the inflation picture potentially deteriorates. I-bonds and TIPS, inflation-protected treasuries, are specifically designed to maintain purchasing power as inflation rises. In a wartime inflationary environment, these become particularly valuable. I-bonds are backed by the U.S. government, and their yield adjusts with the CPI. If inflation runs hot due to supply chain disruption and wartime spending, which history strongly suggests it will, your I-bond return rises with it. Corporate bonds, on the other hand, are significantly riskier in a major conflict scenario. Companies face disrupted supply chains, rising costs, falling demand in some sectors. Corporate bond defaults tend to spike in severe economic stress. If you're holding corporate bonds as a significant portion of a portfolio and global conflict escalates, that's a position worth reconsidering. The bond strategy for an instability-resistant portfolio. Short-term treasuries and inflation-protected securities. Yes. Long-term government bonds, maybe in moderation. Corporate bonds, proceed with significant caution. 7. The assets that tend to collapse. What to reduce or avoid. Okay, let's flip the conversation and talk about what history says tends to perform poorly in major geopolitical crises. Because knowing what to avoid is as important as knowing what to hold. Highly leveraged assets. When markets panic, liquidity dries up and leverage becomes catastrophic. Assets bought with significant debt, certain real estate strategies, leveraged ETFs, highly margined investment accounts, can get completely wiped out in the kind of liquidity crisis a major geopolitical shock can trigger. Deleveraging before instability hits is one of the most important defensive moves available. Currencies of directly involved countries. War devastates the currencies of participating nations, especially on the losing side, but often both sides. The German mark after World War I became famously worthless. Russia's ruble collapsed after the 2022 invasion. If you have significant exposure to currencies of countries that might be directly involved in a major conflict, that's a meaningful risk to understand. Highly globalized companies with concentrated supply chains. Companies that depend on components from one specific country or that have significant operations in conflict zones face extreme disruption risk. This doesn't mean avoiding multinational companies entirely. It means being aware of supply chain concentration risk within your equity holdings. Speculative assets with no underlying value. In genuine crisis scenarios, the assets that tend to survive are the ones with real, tangible underlying value. Commodities, real estate, businesses with essential products. The ones that struggle are purely speculative assets, meme stocks, highly leveraged bets, things whose value exists purely because people agree it does, and that agreement evaporates under extreme stress. 8. Building the actually unbreakable portfolio. Okay, let's put it all together, because I think the most useful thing I can do at this point is give you a clear, practical picture of what a genuinely instability-resistant portfolio actually looks like. Not theory, but structure. Think of it in layers. The core, 50 to 60% of the portfolio. Broadly diversified, low-cost index funds across multiple geographies. U.S. equities, international developed markets, some emerging market exposure. This is your long-term growth engine. Markets have recovered from every major conflict in history. The core doesn't panic, it stays invested. The hedge layer, 15 to 20%. Precious metals, primarily gold, some silver. Broad commodity exposure. Inflation-protected bonds. These are the assets that appreciate in the exact environment where the core is under pressure. They're not trying to drive long-term returns, they're the shock absorber. The real asset layer, 10 to 20%. Real estate exposure, your primary residence equity, REITs, or direct rental property if applicable. Real tangible assets that hold value through financial system stress. The liquidity layer, 5 to 10%. Short-term treasuries and cash and high-yield savings. This is your stability anchor, accessible, not volatile, available to rebalance into other assets if a crisis creates buying opportunities, and major crises almost always do. This structure doesn't maximize returns in a perfectly calm world. In a roaring bull market, a pure S&P 500 portfolio will outperform it. But the goal of a war-resilient portfolio isn't to win in the best-case scenario. It's to survive the worst-case scenario while still participating meaningfully in every other scenario. The chess king in the thumbnail stays standing when the buildings are burning around it. That's the whole idea. Not the flashiest piece on the board, but the last one standing. Thanks, guys. Please subscribe to support us.